Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Inflation for the December quarter has come in at 1.9%, well above forecasts of around 1.6%, taking the annual rate to 7.8%. The all-important underlying rate of inflation was also above expectations. There was a lot riding on the figure, with hopes of a pause in interest rates seemingly dashed by the surprise result. Diana Mousina is the Senior Economist at ANP. Diana, welcome back to Fear and Greed for 2023.
Thank you so much for having me.
So what did you make of the inflation figures this week?
Well, the clear number to me that is going to cause a problem for the RBA's deliberations at their February meeting is the trimmed mean number. We saw that was revised up for last quarter, so the September quarter number now looks higher, and it came in above the RBA's own forecast. So they were expecting core or trimmed mean inflation to peak at 6.5% over the year to the December quarter, and it's come in at 6.9%. Now it's not a significant miss, but it's enough of a miss that the RBA will probably raise the cash rate again at its February meeting, even though we had been of the view that the RBA was done raising rates for this cycle.
Okay, it might just be worth explaining what the trimmed median is. What's it cut out?
So the trim mean is the best measure of core inflation in Australia. In a lot of other countries, it's called core or excluding volatile items. In Australia, it takes out the top 15 and the bottom 15% of those most volatile items. So it gives a good reading of the underlying pressures of inflation in the economy, excluding one-off events. For example, if there's a flood that raises prices for fruit and vegetables, that will be excluded for that particular quarter. But the issue has been that we've seen a lot of different components of inflation move up quite significantly over the past year, and that has creeped into core inflation.
Okay, so I'll get on to rates in a moment, but what are some of the things in the inflation figure that really have risen quite a bit that the Reserve Bank would be worried about?
Well, the usual themes in the inflation story were actually in line with expectations. I guess it's just that price rises have continued to be stronger than anticipated. So the key things that are increasing in price are services. We've seen household equipment and services rise. So things like different types of household services like cleaning services, childcare, costs related to appliances in the household as well. So that's more of the good side. Rents are rising. They're running at about 4% on an annual basis. We've also seen eating out and holiday travel prices rise significantly in the December quarter, which they normally do always because of seasonal demand and school holidays, but it's been more than usual this time round. Other housing-related costs, electricity, gas prices, fuel was up for the December quarter. Clothing and footwear prices normally are flat in December or even have a little bit of a fall because we see more sales compared to usual, because remember that the headline CPI figures are not seasonally adjusted. But this time around, clothing and footwear prices rose because of very high demand from consumers. And food prices are still continuing to increase as well because we have had some issues with flooding impacting the supply of fruit and vegetables in Australia and also other food prices, but also because commodity prices have been so high for so long and they're only now just starting to come down.
Okay, so on to interest rates. You said earlier that a 25 basis point increase is likely when the Reserve Bank meets on 6th February. That's a change in your forecast because you didn't think that they would raise rates, but I suppose obviously the number and that underlying number was so high that they're going to have to now. Is that what you're saying?
Well, I think that the risk is if the RBA doesn't do anything, then the risk is that inflation is more persistent and that core inflation remains high for much of this year. So another rate rise probably doesn't increase the risk of a recession or a significant downturn too much, given that the economy is still holding up quite well. We had very strong retail sales figures for November, which were impacted by sales for Black Friday, Cyber Monday, but they're still showing that consumer spending is holding up much better than anticipated, given that we've had so many rate rises last year. So I think that the economy can handle another rate rise because inflation is just too high and the RBA will be concerned that the trimmed mean or the core numbers are running above their own forecasts. So February, I think, is a done deal, and the risk is then with another one, maybe two. But our view at the moment is that February and then no more rate rises from there.
Stay with me, Diana. We'll be back in a minute. My guest this morning is A&P Senior Economist Diana Mousina. Lots of talk late last year and even so far this year that inflation will have peaked in the December quarter. Do you think that's still the case? That's still the argument?
Well, all the inflation signals that I'm looking at are pointing down. Commodity prices are down from their highs. A lot of talk about gas prices, but gas prices in Europe and the US are now back to where they were early last year. All transport-related costs are now back to their pre-COVID levels. So things like shipping costs have slowed significantly because all those supply chain bottlenecks that we saw over the past year have now mostly passed through. Consumer demand for a lot of those goods has declined, and also some of the issues related with the logistical challenges during COVID and closed borders have really disappeared now because the global economy is completely open and China is reopening its economy as well. The one part of the inflation story that could still be concerning is what happens to wages and if wages continue to rise. In Australia, we think that wages growth will peak somewhere at about 3.75% on an annual basis. We're just over 3% at the moment, but that level of wages growth I don't think is unsustainable. Other economies like the US or the UK have had wages growth running at 4, 5, even 6% on some measures on an annual basis, and Australia is just not going to get there. We don't have the same structure in our labour market that would allow for that high level of wages growth because we've had a big increase in labour supply, whereas some of those other economies like the US haven't had that big increase in labour supply. So you do get more wages growth for those people who are employed. So I am of the view that inflation will slow from here. Australia lagged the rest of the world in the pickup in inflation by about 6 months. US inflation peaked in the month of June in 2022. And I think that the peak for Australia will be in the December quarter.
Okay, so hopefully inflation's peaked. We may get another interest rate rise or two. What about economic growth? The US is likely to hit a recession at some point. What do you think will happen to Australia?
Well, I think the US will actually skirt around a recession, but probably avoid it. I mean, it might not feel very good because the unemployment rate's likely to go up in the US, but at the same time, the unemployment rate in a lot of economies, in a lot of advanced economies now, is at multi-decade lows. The only way for it now to go is up. So we've had a very strong rebound over the past 2 years, and we're going to have to pay for some of that this year, and that's only natural when interest rates go up. So slow growth in the US, but I think the US will avoid a recession. I don't think a recession is a done deal for Australia either, but it does depend on where interest rates go. If we see the cash rate getting towards 4%, then we will have a significant growth downturn in our view, but we don't think the RBA needs to get interest rates to that level to see inflation come down. I think the next few months we will see more signs that inflation is slowing.
Diana Mousina, Senior Economist at A&P, I can't let you go without asking you about house prices. You're still of the view that there's a way to go?
Well, we still think that there's another 8 or 9% to go for the downturn in the national housing market. Of course, there will be variations across the states and capital cities, but the longer that we see the RBA delay the peak in the cash rate, then the longer the property price downturn will take because we know that there are lags involved with raising interest rates. So we think that the bottom in home prices will come somewhere around the middle of this year. But if the RBA keeps raising rates, then the bottom will be somewhere closer to the end of the year. And we'll only see that upturn in home prices once the RBA starts cutting rates, which I think is a likelihood in early next year.
Diana, I have known you for a few years now, and every time I meet you or talk to you, you're such a positive person. I'm afraid today you've done your dash. You are a bearer of ill tidings.
I'm sorry for that, Sean.
Can't do much about it. Thank you very much for talking to us here on Fear and Greed.
Thanks, Sean.
That was A&P Senior Economist Diana Mousina. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.